Welcome, everyone, to the Loans Incorporated podcast. I'm Alex from Loans Inc. We have the Legacy Builder team joining us here today on the podcast. We have Francois Hood and we have Shane Steele. Thanks so much for coming on the podcast, guys.
Alex, thank you so much. It's actually a very... All right, I promise I'm not 10-take guy. Start that over again.
So just go ahead and roll with it.
Alrighty. Hey, thank you very much. It's a pleasure to be here.
Yeah, thank you guys.
Thanks for having us.
Of course. So you guys were a new addition to the team, so welcome aboard to Loans Inc. Why don't you just give us a brief little bit about yourself, who you are, and how you got into the mortgage business?
Well, for me, it was kind of a culmination of a life in business. My parents were in business themselves my entire life, so I grew up in that environment. So coming to mortgage lending was actually a normal path for me. I've always wanted to help people, and it's a thrill still to this day to see a closing and have people see their faces and see how happy they are. And I had a circle which ran into investments and realtors as well, and that's how I got into the business, being a real estate investor myself. I've been investing even in Canada, so it was a perfect fit to just come to this industry.
That's awesome.
So for me, a little bit different than Francois. I've always been very blue-collar type work, driving truck, fixing trucks, working with my hands, and I have 3 kids now. The blue-collar work is very not just 9 to 5. It's 10, 12, 14-hour days. I missed a lot of activities with them, and I just needed to find something that I could be more active. And even though I don't own the business, I still basically work for myself. I work my hours. If they have stuff, I can go do it. And I needed to find something that was suitable for them. Like my dad growing up, he was like me. He worked in a manufacturing plant. I saw him and he was around a lot and stuff, but it was hard because his work schedule, it wasn't as much as I wanted, and I want to be there for my kids a lot more.
Now you get to do something awesome, help people buy houses, which is super cool.
Yep.
Yeah.
Yep.
And refinance. Awesome. Well, for you guys specifically, is there a specific type of client you guys serve, or you guys serve everyone?
For me, it's basically, investment industry. It's such different people that come to you in that sphere. And then you have your normal clients. They just want to purchase a primary home. And, with us, it's to get to the closing table regardless. So since I like to help people, there's not one specific niche that I want to necessarily pigeonhole myself in, because the goal is to either get people in a home, see their faces, see the kids jumping for joy because now they can have their own room and a yard to play in. And on the investment side, it is people wanting to grow their wealth. And, it's not just about getting them alone and be done with it. It's about building a community of investors that can help each other, send referrals, and, get deals through. So it's pretty fulfilling to be able to cater to different types of people like this. And, once again, seeing their joy at the closing table never gets old.
What about you, Shane?
Pretty similar to me. I like both sides of it. They both have their pros and cons. But I really do enjoy the helping people, especially buy their first home. Like I helped my sister last year buy her first home, and she never thought she was going to be able to. And that was such a good feeling to be able to help her out. And I've had a few other ones I've liked that. And it's just being there at the closing table, if I'm able to make it, it's an awesome feeling seeing them.
That's awesome.
Like for me, even adding the fact that it's also not just helping people get to the closing table. It's about getting people that have credit that is maybe spotty, maybe it's just a matter of tweaking a few things, and then all of a sudden making them realize, hey, you can purchase a home. it's so amazing. We even had situation where we had to help some, people out of their relationship because they were in a really bad place. So it becomes a mission to, do things as fast as we can and making sure that they get to be in a safe place with their, families and kids. So, it's fulfilling in those senses as well. It's just not about the function of doing the business. It's about the personal aspect of it as well.
Absolutely. Awesome, guys. Well, are you ready to get into the bulk of the pod? So today I want to make this a guide. So we're going to break this down into 3 different parts. We're going to break it down for investors. We're going to break it down for primary homeowners, and that includes conventional and then government loans, so FHA and VA. So this is going to be a guide for home buyers and people looking to refinance. Any questions? And I'm going to go through a whole bunch of questions and ask you guys, and then we'll go ahead and help the people out who just want some guidance on what they're looking for. Does that sound good?
Sounds good.
Sounds good.
Who is a DSCR loan for?
DSCR, if you're not sure what that stands for, debt service coverage ratio. It is for your investors, the people that want to buy rental properties, multi-units, and stuff like that.
And what's different about it? They qualify based off of the property, not your personal income. So the lender, they're not checking your credit. They're not checking your income. They're checking your credit because you're a personal guarantor. But they're not checking your personal income, your taxes, your W-2. They're just looking at the property's income. So
no, and it's very, like, the way that I tell it is very simple. All you need is a qualifying credit score, enough money to do the deal, and the property pays for itself, and you basically have a deal. It's somehow simpler in explaining to people how those loans work. They are more complicated on the back end, but that's what we do all day, and that's how we help people get through and get their financing on their rental properties.
And what are some of the benefits of a DSCR loan?
You can take that for sure.
One of the main things is you can close in your LLC, which helps protect yourself in case anything happens.
Well, and one of the major things too is we don't need your income documentation. So it really at one point does not matter at all. All they want to know is the property paying for itself? Do you have the credit score, and do you have enough money to close? So, the advantage is you can repeat that as much as you can, as long as you fit those 3 criterias and the building fits the bill. You basically got yourself an investment loan. So it's a very, very good product for anyone that want to grow their portfolio.
Also, too, a benefit that people don't realize, you can buy a home with a DSCR loan with 20% down. While conventional Fannie and Freddie, they require 25% down. So you actually save 5% if you went with a DSCR loan compared to a traditional conventional mortgage.
And people will get scared about the rate, like, what's it going to do to the rate? And yes, it's obviously more expensive than a normal
But not by like a lot.
But not by a lot. And that's the thing people need to understand.
Yeah.
Like, you can get into the investing game and really have an interest rate that will make your property profitable for you and give you the ability to grow if you want to because of those amazing conditions.
So if you qualify for both a DSCR loan and a conventional loan, which one should an investor choose?
I think it depends on the scenario.
Absolutely right.
Which is usually the answer for a lot of things, because each scenario is different. But
I think like the scalability, because I feel like if you get a DSCR loan, your ability to scale your investment portfolio is just at such a higher rate.
Absolutely, because if you go the conventional route, it might be doable, but there's a limit to that, because at one point they also consider your income, and depending on your situation, your debt ratio, it can get really hard to add another one onto the mix, where if you go DSCR, you can do it as much as you want.
Yeah, like whether you have 3 properties or 30 properties, right? Like obviously, depending on your scenario, a DSCR loan, especially if you have 30, it's going to be a lot less document intensive compared to, a regular conventional loan, where we're going to be looking at all your taxes, whether you have losses and all that stuff. So So I guess you as an investor, you guys yourself, if you had to make the personal choice, if you're going to go out and buy a new investment property tomorrow, which would you go with and why? DSCR conventional?
DSCR all day, every day. It's an amazing product, and you can combine it with a fix and flip product, and basically, a good flip is a good flip. A good flip is not always a good hold. However, with the fix and flip, you can do your property, renovate it, and then either sell it outright or convert it to a DSCR loan. And then you can repeat that over and over again. If you make a great deal and you're able to refi, cash out, and get your money out, then you can take that and move it on to the next deal. It's not just about doing loans for investors. What we do as well is educate them how to be able to grow their portfolio and their wealth through real estate by strategizing depending on their objectives, what they have to work with. So it's basically like when I said we're really starting a community of investors, and there's a reason why we're going to get meetups started very, very soon, and that is to bring people together to be able to exchange, to be able to see deals that are coming, and really get professional people to all help each other in growing. There's enough business out there not to share the wealth and get to grow your network of contacts to be able to invest as much as you want, and hopefully get deals even before they get on the market, making you even wealthier as you're in the process. So the community part of what we're going to do at Loans Incorporated is really important in that aspect.
100%. Well, what about you? What about you, Shane?
Well, I'm not an investor yet, but it would be DSCR.
DSCR.
Yeah, yeah.
Mm-hmm. And would you say because you can put less money down, you can close an LLC, the ability to have it not show on your credit? Like, is there a specific reason you guys would really choose that product over, taking a regular conventional loan?
The not appearing on your credit is one big one, especially for investors. And yeah, would I ever do a deal conventional investing? Absolutely not, because the DSCR way is so much better. It gives you so many advantages. You can finance, short-term rental. You want to get into the Airbnb business, these loans can work for you as well. So, it's so versatile, and it's such an investor-friendly loan that, it's the greatest vehicle to grow your portfolio.
Awesome. Any specific reason for you, Shane, or just
pretty much what you said.
Yeah, same.
Yeah,
Same, okay.
Pretty much covered all the benefits.
Do DSCR loans close quicker than conventional loans?
It all depends. It usually can. No, but hey, every deal is different. Like, those loans are sometimes complicated. Sometimes they are super easy. It depends on the building. It depends on the lender's qualification, the person's, ability to even get us documents in a timely manner. Those all play, in line. But yes, it will close, as fast as a normal loan. Sometimes it can take a little longer depending on the particularities. But if we have a deal that needs to close and we need to push things through, as long as there's no hiccup, the appraisal comes back clean, and we have responsive clients, we can definitely do it faster than the average for sure.
Mm-hmm. That's the biggest thing, I think, in that is the response of the clients, and paying for the appraisal as soon as we get that sent to them, and because that can be the biggest holdup. You could have everything ready, and you're just waiting on the appraisal to get back.
So just on average, because I feel like when I get a conventional loan approval compared to a DSCR loan approval, there's just less conditions, I feel like, on average on a DSCR loan, just because there's less need for documents on these loans.
Oh, absolutely. And especially if you're self-employed, you have taxes, you might have multiple companies, and you want to apply with a conventional loan, and we look at all of that. It can be quite significant, and what you have on your taxes versus what we consider to be able to calculate everything could be a discrepancy, and all of a sudden, it requires letters from CPAs and things like that, where with DSCR, it is easy peasy in that sense, no doubt about it. And, our team is built to make sure that, it's fast and it's efficient, and that everything keeps on track. So that really helps too, to get those loans to closing as fast as possible.
Awesome. Next question I have for you guys for DSCR loans. Do you have to close in an LLC, or can you choose to close in your personal name?
You don't have to. It's just a benefit to do it that way.
Sometimes it just depends on the structure of how they do their business. Some people do it all on the personal side. Some people want the LLC to give them some protection. And, those are the things that I will talk to a client as well. There's so many little things you need to make sure that you don't, breach your LLC. Well, we have a little conversation to make sure that they understand a little bit about the rules of the game. I always tell them, obviously consult with your accountant, because I am not one, but being an investor, you need to watch out for these things. Don't pay for your things with your personal bank account or your LLC when it should be completely separated, because then you breach your LLC, and that could cause problems to you down the line. Might never be a problem, but if something happens, then it could be. So we make sure that we advise everyone of the facts so that they can be better in making their moves and their decisions.
Yep.
And if I'm not mistaken, it can actually help with your rate if you close in an LLC.
Yeah, typically. Typically for these specific type of DSCR loans, the lenders like to see you in LLC. Also goes into our next topic, prepayment penalty. Because a lot of times you can't tack a prepayment penalty on under a certain loan amount unless you're closing in an LLC. So if someone's buying a home with an for a DSCR loan, either buying or refinancing, what is the benefit of a prepayment penalty?
Prepayment penalty is basically the bank guaranteeing itself that it will get payments for a certain amount of time. And for them to do that, they will give you a preferential rate to make sure that you pay the loan for the dictated period of time instead of refinancing or getting out of it, early. And if you know that you're going to hold that property, you like the rate, it cash flows, it behooves you to sometimes get a prepayment penalty for the fact that it will save you on the long run. And it's, it fits into some investors' strategy perfectly. And when that does, we always pull the trigger on prepayment penalties.
And then what are some of the common terms for prepayment penalty?
As far as years?
Yeah, years.
Usually 1, 3, or 5.
Yeah, I know some you can kind of change to 2 year, anything between a 1 to 5 year term I've seen. Mm-hmm. What are some of the common penalties? Because you hear prepayment penalty, what is the penalty?
It will be a percentage of, the balance owed.
So the original loan amount. So
correct.
if you take out a $200,000 loan and your prepayment penalty is 5%, then it's what is that? 5% of 200 grand?
5% to 10,000. Yep.
Yeah, 10,000.
Yep.
So $10,000, and that's for that whole entire term.
It is.
So if you take a 5-year prepayment penalty, is it going to be 5% for the whole entire 5 years? If you were to refinance,
it will be prorated with
time.
With
So
time,
because there's flat and tiered, right?
Correct.
So if you have a flat prepayment penalty, it might be the best interest rate possible. But if you're 3 years into your 5 years, you'll have the 5%. Whereas tiered, it starts at 5%, and then every year until you get to zero, 5%, 4%, 3%. Yep. So make sure, a lot of people do not know to ask their loan officer this. I hear it all the time. Oh yeah, I'm taking a 3-year prepayment penalty. Well, what's the penalty? I actually don't know. Ask your loan officer, because if it's tiered, it goes down every year. If it's not tiered, you're going to get hit probably with a 5% penalty if you pay that off early.
Mm-hmm. And what we do is we have many lenders. So depending on what the client is looking for, if it's not doable at one, it might be doable at the others, because DSCR loans, those lenders make their own rule in some sense. In some sense, it is not a qualifying mortgage like a conventional or a government loan where you need to check off every boxes. So every lender can be different. It can be the credit score qualification, it can be the loan amount, minimum loan amount, prepayment penalties. So, we know who does what. So when we get a deal and we talk with a client, it's easy to then say, okay, we can go through these 4 lenders and let's see the best conditions that we can get you, and we'll pick the best one out of the 4.
Yeah. Awesome. Any other things you guys want to touch on DSCR loans before we go into the next topic?
For investors that think it's complicated or expensive, It is not. It is really not as much as you think. And, you know, if you've hesitated before, it's easy. Give us a call. We'll talk. We'll see what you have. We'll see what we can do. And we can definitely prove to you that it is the way to go about it, or have you a game plan that will, you know, fit your growth objectives and truly help you with that. But it is not scary. It is a very useful tool. And for the new investors, don't get scared as well. It is really, you know, hey, credit score, enough cash to close, and the property pays for itself. You know, if you check those boxes, doesn't matter. If you're a newbie, we will help you. We will guide you through, and we will make sure that after your first property, you understand how the system works. And hopefully, you know, we can all grow together and get the client a, you know, wealth strategy, that true real estate that is really on track, and, you know, that we can all end up at the promised land of building real estate empires.
Basically, let us do the hard work on the back end. As long as you're responsive, get us what we ask for, let us do our thing, and it'll be smooth for you.
Yeah, and one thing you brought up, Francois, was the fees. Because people hear DSCR loan, they think, oh gosh, that's going to be 4 points, 5 points. I'm going to be paying all these points. Is that the case with working with you at Loans Inc.?
No, somehow some people think DSCR loans or some this, like, you know, back alley type of deal, like, you know, last resort kind of thing, you know, like you've exhausted your uncles and your family, and now, you know, oh shoot, I need to do DSCR loans. No, not at all. Like, in fact, you would not necessarily notice that much difference in fees than if you were doing it the conventional way. That's basically the bottom line.
Yeah. Awesome. All right. I want to go into the next part of our investor segment, which is fix and flip loans. All right. So fix and flip loans, if you in the audience are not familiar with the fix and flip loan is, a fix and flip loan is essentially a loan, a short-term balloon loan. So they come in multiple different terms, which we'll go over, but typically you get out of these loans in a year to 2 years. And what these loans serve a purpose for is you get in to a property to purchase to renovate it. So there's a set escrow fund for renovation funds, and then you can purchase this home with less than 20% down. You know, typically I see a lot of these, especially first-time investors, buying with these fix and flip loans with 10% down. So we're going to go into fix and flip loans, what your options are, and then maybe some exit strategies on what to do once you renovate the project. So my first question, you guys, is, are fix and flip loans more expensive than a DSCR loan?
It's not, the rate is not calculated in the same way. So it's, you know, we can.
The rates are higher for sure.
The rates are higher.
Well, like fees, like points and lender fees and stuff like that.
You may pay a point, and then, you know, you'll have your normal fees on top of it, and your interest rate will be slightly higher. However, you're talking 10% down of the purchase price, and then you add on your renovations to it. It becomes a loan. You pay interest only, 12 to 24 months. Most lenders will have a minimum period of time where they want their interest. So let's say it's minimum 3 months interest. So you get into your fix and flip, you do it in 2 months, they will still want that 1 month of interest. However, anything after, and you just, you know, pay back what you owe and move on to the next phase of your project.
Anything on that, Shane, about expense on our fix and flip loan?
No, he covered it pretty good.
Yeah.
Hell, it is the tool for people that want to get into the business, that money might be tight, but they have enough to do the deal and they qualify, because if you buy right and you do your renovations, chances are you'll be pulling equity out of that property. And that's the whole goal of real estate, is to basically, real estate investors are money creators. They're not money earners, they create money. And to create money into real estate, you need to have equity. And the best way to do it when you're starting, I mean, it applies to everyone, mind you, it's an amazing product. But as a newbie, you have enough money to do that, and you buy right, and, you know, hopefully you have a good good contacts, good realtors that can really help you. And then you buy the property, you do the renovations, and obviously you need to do the math. It's going to cost you in holding costs, your 10% down, everything else, but if the deal makes sense, then you have a chance at the end to do one of two things. You either keep the property or you sell it off.
Yeah.
And I said before, a good flip is a good flip, but a good flip is not necessarily a good hold. So what that means is if you bought right and, put a little bit of contingency, life is good, you make a profit, but realize that if you would refi that property into a DSCR loan, refi cash out, you would not get all the money that you've put into it. So at that time, you have a decision to make. Maybe it still makes sense, but otherwise you sell the property, you make the profit, and then you move on with life. And, there's another layer to that where you can, what they call 1031 exchange, which is basically you can keep the money that you've made with that property, not pay any taxes on it if you reinvest it into some other real estate. Usually, I think you have 45 days to find a property and 6 months to close on it, and it's done through a company, and we can guide you through that. But it's a great way to build, tax-free wealth if you want, or tax-free income on your capital gains. It really, really, truly helps. So, that's one way to do it. But if you do the property, you've had an amazing deal, and now the property ARV, which is as repaired value, is nice. And if you refi cash out, you can get all your money out of it. Well, then you hold that property, you put a renter in, and that property pays for itself, and you have all your money back, and you move on to the next. So then you have more money for a bigger 10% down. So maybe you can do something bigger. You can buy something outright. It's an amazing vehicle to get into the industry of real estate investing.
Absolutely. Also, I want to ask this question to Shane because we actually worked this deal together. Can you be a first-time investor and get a fix and flip loan?
You can.
Yeah.
Yeah, you can.
Yeah, because I know like a lot of people
remember.
a lot of people think you have to be a real experienced investor or some sort of professional flipper to get these loans, but you really don't. Like if you have a dream and the numbers work and you have the cash, you can get one of these fix and flip loans. Like you don't have to just you don't have to fund it yourself. You don't have to be a full-on professional to get these. Now, experience, if you don't have any experience, they might want a GC, someone to general contract, but that's not even always the case. As long as you have as long as you have the budget, I mean.
And some investors will have some guidelines that they will, give preferential rate to longtime investors. If you've had that many deals or whatever the case may be, there's, options for that as well.
Yeah. Our next question I want to ask you guys is, and we kind of already talked about this, but terms for fix and flip loans. What are the typical terms on the balloon loan? On the balloon loan, that's what I call because once they mature, they pop, and then the lender starts charging a lot in interest anytime you go past that. So you either want to sell or refi out then. But let me ask you guys, like before that balloon pops, what is a typical turn time? I know we talk about 12 months. What are some other months that you've seen?
24 months as well.
I think I've seen 18. Have you guys seen 18?
I've seen 18.
Yeah.
Yep.
Yeah. And then most investors, when they have these fix and flip loans, do they end up refinancing or hold them from what you guys see?
It depends.
Yeah.
It really does
There's
depend.
really no set answer for that. It just depends on the scenario, location, all that.
Yeah.
But you will see some investors, buy different types of property. Not everybody buys the same. So for some, it will be really more intense one way. For some, it will be the other. It really depends.
Awesome. All right, guys. Well, that's all I had for the investor segment.
Right.
So want to move into conventional loans. These are loans, and we're going to talk pretty much from the standpoint of primary residence holders. So we might touch on a little bit of investment here and there, but you guys ready to get right into that segment?
Let's do it.
Awesome. Let me ask you guys, are conventional loans better than FHA loans?
It's the $1 million question. It really depends on the client. conventional loans are amazing for people that have higher credit scores. It really does. Like that's the way it works with rates. The higher the credit score, the better the rates. And, on a first-time home buyer conventional, 3% down is a very good, deal for a first-time home buyer. And, in that aspect, it fits the client that has good credit. If their DTI is lower, like it really helps the file.
My opinion, and I'll give you guys my opinion. Maybe you guys can kind of base it off of that as well. Someone who comes to me, right, same credit profile, 800 credit, the 30% debt to income ratio, same exact criteria, same exact house, single family, and they come to me and say, Alex, which one is better? Should I go with a conventional loan or FHA loan? 100% of the time, I'm going to say conventional loan. And the reason I'm saying that is because there's no upfront mortgage insurance. The mortgage insurance monthly, so upfront mortgage insurance is a percentage of the loan amount that you can finance into the loan, but you're still talking, like 10 grand or more, depending on the size of the house that you're buying. And then also your monthly mortgage insurance. That's if you put less than 10% down, that's fixed, and we're fixed for the whole life of the loan. And it's more expensive than conventional. So, and I think I've seen this though too. FHA rates are actually lower than conventional.
Well, and that's why
I've seen that a lot. With,
but you pay the price.
Yeah, you pay the price, but you're gonna. And some people, that's all they care about.
But even if you get a savings right on your interest rate, let's just say your interest rate is 0.25% of a better interest rate, and you're saving, let's just say, on your principal and interest $20 a month. Well, you know what's going to be more? Your mortgage insurance. That's probably going to be more expensive. And then you're also going to have your upfront mortgage insurance, which shoots up your loan amount. So that adds to your monthly payment. And then you're still paying the additional amount over 30 years.
Correct. And the one thing with that, it really depends on the client, because I have sent perfectly well-qualified conventional buyers to FHA, but it depends on the situation. Some of them at, 0.75% better. And then, our job is to basically figure out what is the best option for the client. And we do the numbers conventional, we do the numbers FHA. Somebody add more than 10% down to put on an FHA loan. They added conventional, but then we looked at the rate, and, if you put 10% and more on an FHA loan, your mortgage insurance will actually drop after 11 years. Otherwise, if you have lower than that as a down payment, it stays for the life of the loan. However, that person got an extremely good rate compared to the market because they had an extremely high credit score. We went FHA. They got the better rate. They put more than 10%. So if they never refinance, because the rates, are not advantageous to do so, at least in 11 years, the mortgage insurance will drop versus 10 years on a conventional loan if you don't put 20% down. So it's really client dependent. It's really our job. Like, some people think they're going to do conventional, and then all of a sudden we get a, realtor that says, please check the numbers for this property. And we realize that it's actually where USDA, does loans in the rural areas, and all of a sudden they have 0% down. The job of a loan officer is really to prod and probe the client, and then to give them all their options.
What I say, an FHA loan, I think, in my opinion, one of the benefits that's not really talked about are the streamlined refis. Conventional loan, like let's just say tomorrow, right? Let's just say the average rate today is 6%. Tomorrow, the Fed and the government, we're going to slash rates down to 4%. So if you're a conventional home buyer, first off, you're not going to be able to get us on the phone. We're going to have to, automate clone ourselves because everyone's going to be reaching out to us. But if that happened in a day, right? The first thing that you're going to realize is FHA buyers or FHA homeowners, they're just going to have to give us a couple docs and we can do a streamlined refi. While conventional, we're going to have to do a full doc, full whole process. It's way more expensive.
Like starting over, basically.
You're starting over. New appraisal.
Well, the FHA Streamline, there's an option without an appraisal as well. So
exactly.
I have one going on now. It's amazing.
Yep. Now, you can get, for conventional, you can get title acceptance. So you can waive lender's title insurance. I have one right now where customers doing a rate and term refi, and they're paying $75 for lender's title insurance.
Wow.
It would be like $2 or $3 grand without that. And they also have an appraisal waiver. So, but it's not as common for conventional to get all those benefits, but streamlines are great. So want to get back on the topic of conventional loans because that's what our segment here. Home ready conventional loans. How do you qualify for a home ready conventional loan?
I'm not that
Well,
the home ready side.
Home Ready is basically the conventional first-time home buyer program, if you want. So if you are at 80% of the area median income in your area, you can qualify. And what that does is that it gives you a 3% down conventional, and most likely all you'll have to do is take a little homeowner's course, which is really not hard to do at all, and you can do it for free.
It's open book.
It's open, yeah, yeah. Don't need to sweat that one, but that certificate gets you the home.
And the rates
ready
are really low too.
The rates are lower. The mortgage insurance is lower. So, it's a no-brainer. If you qualify, we send you that route. It's easy peasy.
Yep. Fun fact about home ready, because I actually ran into this. A lot of people don't know. If you are getting a home ready loan and you own more than 2 properties already, but you qualify income-wise, you cannot use a home ready loan. I just learned this. I didn't know that before, right? So I had a client, they made maybe $75,000, $80,000 a year. So they were within the income limit, but they owned a rental property in a different state. And then their current primary, they were converting to a rental and they were going to move to this new house. Well, the issue with that was I got pricing for home ready. I was quoting home ready. I'm like, let me double check something really quick. And I found out if the client already owns 2 properties and they're buying their third and they're going to hold on to those 2, they cannot qualify for home ready.
So they'd have to sell one of the properties?
They'd have to sell one. They can own one other one. That's it.
And the one thing too, we talk about first-time home buyers. However, if you have not owned a home for 3 years, you've owned a home before, but now it's been 3 years, you can actually qualify for that same program and get your 3% down. It's amazing.
Yeah. Want to ask you guys the next question. Are conventional interest rates lower than FHA and VA loans?
In my experience, they're a little higher.
Yeah.
Like we talked about, the mortgage insurance is going to be cheaper, but the rates are usually a little higher.
Yeah. Yeah.
Yeah, for sure. And, those government programs are made for first-time home buyers. Yes, you can get an FHA loan if you're not a first-time home buyer, but those are geared really towards first-time home buyers. So, that is why the conditions are slightly better because they want to promote home buying.
Should you put 20% down on a conventional loan?
If you have it to do, yeah.
Mm-hmm.
But should you? Because I get this question all the time, like, Alex, how much should I put down? Should I put down 10%? Should I put down 20%? The answer I always give is, well, it's not a matter of what I think you should do. It's a matter of how much comfort you feel with your mortgage payment. Because if you feel comfortable at a certain number and you can only achieve that monthly if you put 20% down and you have it, well, maybe you should put 20% down. But I also I run this scenario too, all right, and you guys will like this one. I run the number at 20% down, 10% down, 5% down. And then I say how much you save each month. Well, typically, if you look at from the perspective, maybe you're saving $200 a month versus 10% or 20% down. But I look at how long it would take you to recoup that money. Mm-hmm. So it might take you 5 years, 6 years to recoup that money you would have spent putting more money down. And typically people weigh that out, and still a lot of people go off the monthly comfort.
Correct, but then some people it ties into buying points. For some people, it makes sense. For some people, it does not. No. It's really a case per case basis because if you look, then how comfortable are you with your money? How much what's going on in your life? For some people, it might be like, look, instead of putting 20% down, let's put just a little less, and then you can just put extra every month. And if you do that, it's going to be about the same investment over time.
Correct.
If you put that extra. So it's a matter of strategizing with the client.
And I always tell us too, like, if you go in, you're really uncomfortable with the payment, right? And let's just say 2-3 years go down the line and you keep building the savings and the rates drop a little. You could technically refinance, put more money down towards the principal, get a lower rate, and then restructure your loan. You can do that. I mean, you're going with another closing and you're paying closing costs again. Yep. However, though, if you're just really looking at your monthly budget, and also too, what we can do now is we can do custom loan terms. So we don't need to reset you to a 30-year fixed. If you have 20 years left or 22 years left.
Yeah, exactly. It doesn't need to be exact.
Right. Yeah. We can refinance you into a 22-year term so you don't have to go back into a 30-year term. Yep. Awesome. Next question I have for you guys is, what is the least amount you can put down on a conventional loan?
3%?
3%. Yeah.
If
you're first time home buyer.
Correct.
Yeah. And then what if you're not a first time home buyer?
It goes to 5%.
5%.
And the amazing thing with conventional, sorry to bring this back into more than just a primary residence, but it used to be with conventional that you would have to pay higher down payment as you went up in the numbers of units up to 4, and now they have changed where it is 5% regardless. Yeah. So the entry into the super Cadillac of loans conventional,
you have to live in it, though.
Correct, but then again, you need to live in it for a year.
You have to have the intent to
like
live in it.
House hacking, it's a real
thing. You have to live in a
thing.
shoebox for a year to get your investment property. Rough it out.
Should you pay 20% down? Well, it depends. For me, like cash is king, and I'm an investor, and the greatest way to invest is using other people's money, and tying 20% up in a property, to me, does not make sense at all. Like my brain wants to explode because I see what I can do with the extra money lying around.
Exactly. Here's another question. So we know about the least amount of money you can put down on a primary purchase. Well, what on investment conventional purchase? What's the least percentage down you can put down on an investment?
Good old 5. They changed it.
What if you're just buying straight investment? Nope, you're not
straight
living.
Investment. Not living. Yeah. What am I talking about? Oh boy. All right, so that's 25% down.
25%.
Yep. But still, we'll get you into a DSCR loan.
Yeah. Let me ask you guys, in your personal opinion, do you think right now is a good time to refinance your mortgage?
I had go ahead if you want to, but
depends on where you're at now. But there's lots of advantages, whether it's paying off other debt. You can roll that into your mortgage. I've done it myself. I've refinanced my home to pay off my car and some other much higher interest debt I had.
Mm-hmm. Mm-hmm. And for some people, it's about interest rate, and it makes sense. I have this rate, I can get that rate, let's do it. But for some people, it can be financial, and the rate at that point is not a problem as long as by doing the deal, they get their situation better. They might have wiped off a bunch of payments, and all of a sudden, even though they have a higher rate, they actually have a debt-free lifestyle or almost debt-free, depending, obviously.
You guys want something crazy? So I have a VA client. We're doing a VA interest rate reduction loan right now.
Mm-hmm. Those are amazing.
Yeah, so get this, right? We closed June of last year at a 6.25. Today is March 19th of 2026. So the one client, they're finishing up their residency. They're going to be a doctor, and they're going to be making exponential income in the next 2 years when they finish. We did an interest rate reduction loan today. They're doing a 5-year ARM. So it's an adjustable rate mortgage. So it's fixed for 5 years, and then it can change. I think up to 1%. It changes once a year for the life of the loan, but you can refinance that at any point. 4.25, 4.25. They went down 2% on their home, and this is like they do well. Like this, they make great money, but compared when the missus finishes residency, their income's gonna like 5x. So this is a huge savings that they have for the next couple of years. After the next couple of years, then It doesn't even matter. They can refi out, and those loans do protect you. There's a certain amount they can't go above.
Yeah.
So people think, oh, well, what if the rates go to 30%? That's capped. It's capped at a
Always.
certain percentage.
Yeah.
So you're never going to be in that scenario. So, and talking about conventional too, I have some clients right now in conventional loans who are refinancing because they closed over the summer like 6.875. We're doing a refinance right now at 5.875. They're getting a whole percentage lower. It saves them $200 a month, and their PMI is reduced as well, which a lot of people don't even account for. Your PMI can go down with a refinance. So if you're paying $120 a month right now, well, your PMI goes down. That saves you to maybe goes down to $50 a month, and then your principal and interest goes down. So. Anyway, another question I want to ask you guys is for kind of people who are considering investing with a conventional loan. Can you close a conventional loan in your LLC?
No, you cannot.
No, you can't.
Nope.
No, you can't.
Well, you can close in a
We
trust,
discussed this.
right?
We discussed this morning in our meeting. Yeah.
Really?
Yeah, that came up. Yeah.
What you guys talk about?
I think it was one of your deals you're working on.
Would they wanted to close an LLC and you told them they couldn't?
Well, because
because you can, right?
Yeah,
It's so what they do? Did they flip? Did they want to go to a DSCR loan, or they just want to close in their name?
no, because then if they close in their name, they're adding taxable income that they don't want. They don't want to do it through an LLC. That gives them more leeway into even expenses. Yeah. When you have an LLC, it makes a huge difference, and you can. If you have a good accountant, you can definitely save a lot at the end when it comes to tax day.
Yeah, 100%. Anything else you guys want to talk about on conventional loans before we move into our government loans segment?
Yes, it is the number one, the Cadillac of loans, and it is absolutely amazing. So if we can fit you there, it is definitely something that we will do. It is not bulletproof, but it is, a great way to get solid, best rate, low mortgage insurance if you don't have 20%. So, yeah. And in the investment world, it is okay. But,
Well, let me ask you, on an investment and conventional loan, for conventional, can you add a prepayment penalty?
No, absolutely not. No. And prepayment penalties on DSCR, you need to have a minimum loan amount of $329,000.
Yeah, because you can't. I think if you have a prepayment penalty, you have to close in your LLC. Yeah. I don't think you can have.
Oh, absolutely.
PA, you can't. No.
Well, and PA is
it depends on the state
as well.
Yeah.
For that.
Here in PA, you can't.
We can get lower depending on the lender, the 319, which is cool. But you have the LLC.
Yeah.
Oh, and which brings me back to the DSCR one. But DSCR loans in Philly, not many lenders do them, but we have lenders that do them in Philly, and that's
Philly,
huge.
Baltimore, DC, Chicago. I know Chicago's pulled out by a lot of investors right now. Yep. So if you're having trouble, if you're investing in any of these cities, us as mortgage brokers and for business purposes, we can close like 39 or 40 different states, something like that.
Yeah.
So if you're unable to close with your current lender, definitely reach out to us. We can take a look at it and see if we can help. Let's move into FHA loans. Why would someone use an FHA loan compared to a conventional loan?
Like we talked about, usually you're going to have a lower rate, and it's geared towards first-time home buyers.
And one of the things, too, if you want to go conventional, most likely your interest rate is going to be kind of what blocks you, because if you don't have 20% down and you have a lower credit score, your mortgage insurance premium is going to be significantly higher, like 1.20%, for example. It could be even higher than that, where a super good credit score conventional loan will get a 0.22, 0.25 factor, which is basically a percentage of the loan amount that becomes your mortgage insurance. But with FHA, it is capped at 0.55. If you put 5% down, it's 0.50.
Or even 30% down.
Correct.
Which is unfortunate. It's fixed.
Yeah.
But let me, this is something this is a great analogy, right? If someone asks me that question, right, I describe you as a borrower as like when you're presenting yourself to a bank, it's like a dating profile. Instead of people looking at your age, they don't look at your height, they don't look at your education or what color your eyes are, right? They don't care about any of that. Yep. They look at different things in your profile. They look at your income. They look at your credit. They look at your job history. Are you switching a bunch of jobs? How often are you switching your jobs? Do you rent? Do you own? How long have you owned for, right? These are kind of the things that build up what's called your buyer profile. So the way I like to think of it is like, this is your dating profile. You are presenting yourself to different prospects, right? And then us as the loan officer, we're your matchmaker. We're going to match you up with best loan product for you, right? So if you're someone who has maybe challenged credit, maybe you have under 650, maybe you have a 620 or a 580, you want to buy a house, you have maybe 3.5%, 5% to put down. That all day to me is screaming FHA. You're an FHA buyer.
Yep.
If you have an 800 FICO and you have 20% you're looking to put down and your debt to income ratio is a 30, you're going conventional.
Yep.
But I'm going to add something to that. Your debt to income ratio, right? This is your income versus your debts. So you could have an 800 credit score, enough to put 20% down, but your debt to income ratio. Correct. If you have over a 50 debt to income ratio, you're going FHA. If you want that house, you're going FHA. Either you buy a less expensive house or we go FHA.
And it does happen quite significantly.
Yeah. Next thing on FHA.
I was going to say, and one of the big difference as well is we haven't talked about that yet, but is seller's help.
Oh yeah, seller's assist. Oh yeah, let's talk about sellers. So what is? Explain what seller's assist is, and then how much you can get in conventional versus FHA.
FHA is up to 6% of the
sales price. Yeah.
Sales price, yeah. And basically that can go towards. It comes off of what the sellers get, and go towards closing costs, down payment type, total cash to close. And a lot of ways realtors sell that is they'll up the purchase price asking amount to offset that, so the seller's still gonna get.
The only risk is that obviously the appraisal. It still has to appraise.
Yeah, it still has to appraise at that higher
as long
price.
as that.
Some people, I see a lot of times if they're going in a 300, maybe they'll do 305 and then ask for that seller's assist back. So it's not a crazy difference.
Correct.
Like I've seen someone try to do like 20 grand more. It's like, dude, that ain't working.
And especially in this market where houses still sell pretty good, for the seller to accept a seller's help offer, and if they have a conventional buyer, 20% down for the seller, it's an easy decision. But even though you have 6% on FHA, the thing is that you can actually get more on conventional. It just depends on how much you put down. So normally it's only 3% on conventional, but if you put 10% down, then you can go to 6% seller's help. If you go to 20% down, then you can go to 9% seller's help. So if, depending on your situation, 9% is pretty incredible.
Yeah. Want to get through because we're almost about an hour in, so I want to get through these questions.
For sure.
Yeah.
FHA loan. Can you house hack with an FHA loan?
Yes, sir.
Yeah. And up to how many units can you buy with an FHA loan?
4 units.
4 units.
Yep.
And then you have to live in obviously one of the units, FHA. You can't buy it as a pure investment. But what about self-sufficiency tests? Do you guys know anything about that?
No.
So essentially, if you're buying anything more than 2 units, like a 3 and 4 unit, your property has to pass a self-sufficiency test. So what they do is you have your rents for each unit. So let's just say each unit rents out at $1,000 each, and your total is $4,000. But your mortgage payment is $5,000. You're failing the self-sufficiency test because what they're doing, they're taking the total rents, they're knocking 25%, they're tacking that on. So your monthly mortgage payment has to equal that number, or they're you know what I mean?
I didn't know what it was called. That's what yes.
1-to-1 ratio. So they knock 25% off for vacancy. So 4,000, subtract out 25%, and your mortgage payment has to match that 1-to-1.
And it goes as to if you buy a 2 unit and the other unit is rented, whatever rent they have will take 75% off of that. And then, like, that
Give it to you as income.
give it to you as income. The 25%, boosts your income. So it's really nice, and you're buying a property that's going to hopefully cash flow, at least help you make your monthly payment, and you get that advantage as well.
Correct. If you're buying an multifamily property with 3 to 4 units, make sure you run that property by us, your loan officer, first. So we can at least go over that with you to see if you might have any issues with the self-sufficiency test. I'll be honest, when I was a newer loan officer, when I ran into that for the first time, I'm like, oh my gosh, like it's like cake in your face. Like, hey guys, you need to buy the interest rate down a little bit to get you there. But luckily they were able to do it. So on FHA loan, what is the minimum down payment required?
3.5%.
3.5% down.
Yep.
Okay. And how long does mortgage insurance last on FHA loans?
Less than 10% down, it's the life of the loan.
It's a long time. It's 30 years of paying that, right?
Yep.
It is.
Yeah, if you don't pay off early.
Yeah.
Yeah. And what if you put more than 10% down?
On FHA?
Yeah. How long does that last for?
It
I think it's 11 years, right?
It's 11 years.
11 years.
It's only one more year than a conventional. So like if the math works, it's well worth it.
Well, I know conventionally you can request it to come off before. I think
You can
it's
request
after
it
like 7 or 8 years.
Once
right?
you're at 18%
Yeah.
paid.
But I see when I go through, because I like to go through the loan docs at closing, so I'm reading it. It's like, all right, so your maturity date is March 7th of 2020 or 2036, but it'll come off automatically February of 2020 or 2038 or 2037. It's like 1 year later. It's like you're going to pay mortgage insurance for an extra year. If you just made a phone call, hey, remove it.
Yeah, but you had to be in good standing and good payment.
Right,
history.
right,
They won't, It's not automatic. You can just request it.
And depending where you buy, your home could have got an amazing value.
Yeah.
And before that time, you organically have the 20%, and you can just refinance and get it dropped.
Yeah, 100%.
Well, refinance or ask to.
Yeah,
get
the
it dropped
service
with
will
an
roll
appraisal.
out, right? Yes.
They'll
Not-
ask
You
for
may,
appraisal.
you may have to pay
Not
for
all of them.
appraisal to get it done. Yeah.
Yeah, not all do, but
Not all.
don't depend on it. Are there extra fees with FHA loans?
Besides
Just the upfront mortgage
just
insurance,
besides
right?
the
Is there
upfront
anything
mortgage
else?
insurance, that's it.
No.
No. The appraisal will be slightly higher than conventional, but nothing.
much.
You're not going
Just
to
because
break
they
the
look
bank.
for more things.
Awesome. And then, where did I lost the list? It closed out. Next question I have for you guys is, are the interest rates higher with FHA loans? I know we talked about it.
Yeah. They're generally lower.
Yeah, they're lower.
Yeah.
Yep.
Yep.
And if you have a high credit score, it will be significant. It can be significantly lower. So you always check the options.
Yep. And can you explain an FHA streamline refinance in 30 seconds or less?
It's a great. It's a basically
Ready? 3, 2, 1, go.
Basically, a streamlined refinance will. It's a simpler process to do it. It's less documents. It can come without an appraisal, and it's the fastest way to get you through. Like if everything checks out.
No credit check, right?
No credit check.
Yeah.
Nope. Yeah. And there's a few other advantages as well, but the no credit check and the no appraisal, if you can qualify.
Do you need an updated pay stub? You need like one. I think it's a mortgage statement, right? An updated mortgage statement.
Correct.
And is it a pay stub too, or no?
My gosh.
I don't think
No,
so.
we didn't have a pay stub.
No
Nope,
pay
not
stub,
at all.
just-
Mm-mm.
All it is updated mortgage statement, updated homeowners insurance.
They just basically, it's a continuation
It's
of your
continuation,
loan.
just
They
it's a lower
just
rate,
reset
just
it
a
to the
lower
lower
rate.
rate. Yeah.
Yeah. Cool. Shane, do you want to add anything on that, or
As far as the streamline?
anything? Yeah, anything on the streamline?
No, you covered it.
Yeah.
Oh, no. Like,
It's very similar to VA.
Yeah.
So, yeah.
and it is truly less fees.
Yeah.
And a story. Like if you qualify, it's a no-brainer.
a
You don't want to do straight up
Yeah.
FHA refinance.
And you can increase your loan amount too to cover, like if there's any additional like escrow or prepaids, you don't have to like come out of pocket with it.
Correct. And any refinance, what I really like, if it fits your needs, whether it's a rate reduction, whether it's debt consolidation, whatever the case may be. I completely lost my train of thought. Oh, no. My gosh, I did. I'll come back to it. It's the second time that I wanted to say it in the conversation, and then
It'll come back.
It will come back.
We want to go into VA loans now. So VA loans.
Go ahead. All right. So anytime that you refinance, what's really cool is basically you can skip 2 payments because when you refinance, we're going to pay your mortgage off. So what we do is we don't have you pay your coming the month that we will close in.
If it's before the 15th, right?
Correct. But if it's after the 15th, you'll just, you'll pay that penalty will be added to the loan as long as you don't pass 30 days. But we'll never risk that.
Yeah.
But, that would be the only difference. So
you essentially skip 2 months.
Correct. Because now you don't pay the coming monthly payment. And when you close, your first payment is not the next month, but the following month. So that's the second payment.
In April, your first payment's not due until June.
And then so you save that first payment, you save the payment in between, and also whatever's left in your escrow account, because we will redo an escrow account on most cases, and then you'll get whatever is left in your old escrow account back to you.
I think it always will come back. I don't think it's allowed to transfer.
No, it can't.
No, it has to come back to you. Any remaining that's in there,
Yep. Awesome. Let's go into VA loans. This is our last segment of today. Do all veterans qualify for a VA loan?
No, they do not.
So how do you qualify as a veteran to a VA loan?
Depends on your time in service and if you're removed from service, depends on how you were discharged. So if you were dishonorable discharge, you're not gonna get that benefit.
And this is a question I actually have later, but I want to ask you right now because it fits into it. Can active duty military personnel qualify for VA loans?
Yes.
Yes? Okay.
Yeah.
All right. And are VA interest rates higher than conventional or VA loans? Or, conventional or FHA loans?
They're around
Okay. Are VA interest rates higher than conventional or FHA loans?
They're around the same as FHA, lower than conventional.
Okay.
Yeah.
And is there mortgage insurance on VA loans?
They're not because it's backed by the VA instead of a...
So you don't pay a monthly PMI or monthly MIP?
Nope, none.
It's beautiful. And there's a VA funding fee. So what is the VA funding fee, and do all veterans have to pay it?
The funding fee is basically for like admin fees and like registration and stuff. But if you have any type of disability, then you do not have to.
You can get waived for a certain percentage. If you're a certain percentage disabled, you get waived for that funding fee, correct?
Last I checked, I don't know if there is a limit on as far as what disability percentage
or a limit on. Okay.
Yeah. So you could be at 10%.
10% or more gets the funding fee to save waived. I think it's 10%.
Yep.
And can you finance all your closing costs on a VA loan?
You can, but usually sometimes seller help will really help you.
Like you can't finance your taxes, your prepaid, your lender fees.
Yeah, no, you can't.
You
can't
get
finance
the seller to
that,
pay for
but you can get seller's help because.
And that's at 4% of the sale price you can get up to. I think it's 4%.
6.
Yeah.
VA I think is capped at 4.
Fix. Yes, fix 6.
I think it's 4. I'm 90% sure it's 4.
We'll have to double check. I thought it was 6 as well, but
let me look it up.
but like
He
when
pays the beer.
like I use VA myself on my home, and I didn't pay.
Yes, veteran. So thank you for that.
I didn't pay anything at closing with the seller's help, and I actually got money back that day.
It cannot exceed 4% of the loan. VA can close concession umbrella. 4% is on concessions for VA loans.
Well, apparently I'm paying the beer.
I'll take you up on that.
All right. Sorry, honey.
Cut that part out.
Here's a question, or here's a fun one again. What is a VA interest rate reduction loan? Tell us in 30 seconds or less.
Very similar to the FHA. They don't check credit, don't check income. Basically, you're just getting a lower rate. You can't do a cash out, and you can do them fairly quick within a few weeks. So you can get them closed.
Awesome. And can you use VA disability income towards qualifying?
Yes.
And you can use that on top of your current job?
Yep.
Okay. And that's all I had. Anything else you guys want to talk about on VA loans?
Like he said, he went to the closing table and basically got money back that day.
I got a couple hundred back that day. They wired to me. I bought a house and got money back same day.
You know, obviously you're not getting $10,000
No,
back,
it
but
was
you
like
know, getting
$250 bucks or something. Yeah.
sitting and signing for a house and walking out with a
There's
nice
a
meal for you
cap.
and your family.
I think the cap's $500. You can't leave with more than that. But yeah.
Wow.
Yeah, but and you know, with seller's help and with 0% down on a VA program, basically we seriously can get you with little to no money down and get you the house of your dreams.
Wow, that's amazing. Well, thank you guys so much for joining us today. It was a pleasure having the Legacy Builder team.
Thank you.
Themselves here in person. Great seeing you guys, and you know, integral part of the Loans Inc. team. So we appreciate you guys being here, and make sure to subscribe to our YouTube channel for more mortgage content. Till next time.